Most people think the 2008 financial crisis was a sudden accident, a lightning strike that no one could have seen coming. They're wrong. It wasn't a thunderbolt. It was a slow-motion implosion decades in the making, hidden behind optimism, greed, and faith in numbers that weren't real. By the time the collapse came, the warning signs had been flashing for years, but no one wanted to look. Because everyone, banks, governments, investors, and even ordinary families, was getting rich from the same illusion. This is the story of how the modern world built a tower of paper, called it wealth, and watched it crumble in 2008. And by the end, you'll see why the next collapse might already be underway. It started with a dream, the American dream, a belief that everyone deserved a house, and that owning one meant safety, stability, and success. But dreams can be dangerous when banks learn how to sell them. In the 1990s, interest rates were low, Wall Street was booming, and financial engineers invented a machine that seemed unstoppable. It turned risk into profit, at least on paper. That machine was called the mortgage-backed security. Here's how it worked. Banks issued home loans, millions of them, to people across the country. Those loans were bundled together into giant pools and sold to investors around the world as safe assets. After all, everyone pays their mortgage, right? The logic was seductive. Housing prices had never fallen nationwide. So Wall Street convinced itself, and everyone else, that they never would. But to feed the machine, banks needed more loans. And soon, they ran out of borrowers who could actually afford them. That's when the rules began to change. Lenders started approving anyone with a pulse. No income? No problem. No job? No verification needed. They called them subprime mortgages, high-risk loans dressed up as opportunity. The result was a national illusion. Entire neighborhoods were built on borrowed money. Construction boomed. Real estate agents made fortunes. And people believed they were wealthier than ever because their house price kept rising. But behind every new home was a promise that couldn't be kept. Every time a loan was issued, it was sliced, repackaged, and sold again, not once, but dozens of times. Risk was chopped into pieces so small that no one could see it anymore. Rating agencies, the supposed gatekeepers, stamped these products AAA, as if they were as safe as government bonds. It was financial alchemy. Banks took the lowest quality loans in history and turned them into the highest rated investments in the world. Everyone wanted a piece. By the early 2000s, Wall Street was hooked, and like any addiction, it needed a bigger dose to keep the high going. When traditional mortgages ran out, they created synthetic ones, bets on the bets themselves. It wasn't just about homes anymore. It was about gambling on the idea that housing would never fall. There were warnings, loud ones. Economists like Nouriel Roubini and journalists like Michael Lewis pointed out the insanity, but their voices were drowned by the noise of euphoria. Home prices doubled in less than a decade. Families flipped houses like trading cards. TV shows celebrated house flippers getting rich overnight. Wall Street was making billions. And regulators? They were asleep or looking the other way. Alan Greenspan, then head of the Federal Reserve, believed markets could self-regulate. He called it rational self-interest, the idea that people wouldn't take risks that could destroy them. He was wrong. In reality, the system rewarded recklessness. The more risk a bank took, the more profit it made, and the sooner it could pass that risk to someone else. By 2006, debt had become the lifeblood of the economy. Household debt in America surpassed $10 trillion. Every borrowed dollar was another brick in a tower of promises, but no one realized how hollow it was. Then, one small thing happened, a tiny tremor in the foundation. A few homeowners stopped paying their mortgages. Just a few. But those defaults began to spread quietly, invisibly through the entire system. The illusion started to crack. At first, Wall Street shrugged. A few defaults were normal, they said, but they didn't understand how interconnected everything had become. Each mortgage was tied to hundreds of financial contracts. Each contract was leveraged, insured, and resold thousands of times. When one piece failed, it weakened the whole network. And when people started selling, the prices of those securities dropped. But because no one knew what they were truly worth, The market froze. Banks stopped trusting each other. It was like a circulatory system, suddenly losing its heartbeat. Credit, the lifeblood of modern economies, stopped flowing. By 2007, the panic began to surface. Hedge funds collapsed. Mortgage companies went bankrupt. And the word subprime became toxic. Yet even then, most believed it was contained. Ben Bernanke, then chairman of the Federal Reserve, said the crisis was likely to be limited. It wasn't. The shockwaves had just started traveling across continents, through balance sheets, and into the homes of millions who had no idea what was coming. By early 2008, the illusion of safety was gone. What had once been the backbone of global finance, the US housing market, had become a black hole, pulling everything toward it. But the banks didn't know how deep it went. No one did. Inside skyscrapers in New York and London, analysts stared at screens filled with numbers they no longer trusted. The models that once predicted stability now produced chaos. Losses mounted, and yet, the bonuses kept coming. The first giant to stumble was Bear Stearns, a 85-year-old investment bank once considered untouchable. It was heavily invested in mortgage-backed securities. When their value collapsed, so did Bear's liquidity. In March 2008, the firm was sold to JP Morgan Chase for $2 a share, a humiliating end for a titan. It was supposed to stop the contagion. It didn't. Behind the scenes, every major bank was holding the same toxic assets. The names were different, but the story was identical. Each one believed it was diversified. Each one believed it could sell before the crash. None of them did. Then came Lehman Brothers. Founded in 1850, it had survived wars, depressions, and panics. But in 2008, it became the symbol of financial hubris. Lehman's balance sheet was a mirage. It hid billions in off-book debts, disguised risk with creative accounting, and borrowed over 30 times more than it owned. When investors realized the truth, confidence evaporated. Lehman's stock plummeted 94% in a year. Executives begged for rescue, first from the government, then from rival banks. But by September 15, 2008, the clock had run out. Lehman Brothers filed for bankruptcy. It was the largest corporate failure in US history. The fallout was immediate. Money markets seized, global trade halted, banks stopped lending, even to each other. Within 48 hours, trillions of dollars vanished, not in smoke or fire, but in zeros disappearing from screens. It was a silent catastrophe. Ordinary people watched their retirement savings collapse overnight. Jobs vanished. Factories closed. Homeowners lost everything. And still, few understood why. The crisis wasn't just financial. It was psychological. It shattered the one thing modern economies depend on more than money: trust. When Lehman fell, everyone asked the same question: who's next? And that question became contagious. If one giant could fall, maybe they all could. Fear spread faster than any virus. And soon, the panic reached the core of the global system. AIG, the world's largest insurer. AIG had sold billions in credit default swaps insurance on the very mortgage securities that were now collapsing. When those securities failed, AIG was on the hook for losses it could never pay. It was a ticking time bomb hidden in plain sight. The company's collapse would have triggered an even greater catastrophe, a global chain reaction. So, within days, the US collapse, government stepped in with an unprecedented bailout, $182 billion. It was a desperate attempt to stop a domino effect that threatened to erase modern finance itself. The rescue came at a price not just in money, but in morality. The government poured hundreds of billions into failing institutions: Bank of America, Citigroup, Morgan Stanley, while millions of citizens lost their homes. The message was clear. Some banks were too big to fail, but ordinary people were not too small to save. For Wall Street, it was survival. For Main Street, it was betrayal. Behind the closed doors of Washington and the Federal Reserve, panic meetings stretched through the night. Officials feared a total collapse of the financial system: ATMs not working, grocery stores unable to restock, paychecks bouncing. They decided to flood the system with liquidity, trillions of dollars created out of thin air. It worked, technically. The market stabilized. Confidence, at least on paper, returned. But something deeper had broken. Because the bailout didn't fix the cause. It only reset the cycle. The same logic that had built the bubble was still intact. When risk leads to profit and failure brings rescue, the system learns nothing. The 2008 crisis wasn't the end of an era. It was the beginning of a new one, where money itself became abstract, and central banks became the ultimate creators of value. After the chaos, the Federal Reserve launched a radical experiment: quantitative easing. It printed trillions to buy government debt and mortgage securities, lowering interest rates to zero. The idea was to stimulate recovery. But in practice, it created a new illusion: wealth without production. The stock market soared, assets inflated, the rich got richer. And once again, people believed the system had been saved. But underneath, the same imbalance was growing: too much debt, too little real growth, and a world addicted to cheap money. In the past, kings had diluted their coins. Now, central banks diluted reality itself. The modern economy became a simulation: numbers detached from labor, profit detached from value, and confidence detached from truth. The collapse of 2008 didn't destroy capitalism. It transformed it from a system of competition to a system of constant rescue. When the dust settled, the world had changed, though it didn't look like it at first. Skyscrapers still stood, markets reopened, politicians declared victory. But underneath the surface, something fundamental had shifted. The system had survived, but only by redefining what survival meant. Governments and central banks had learned they could print their way out of disaster. They had discovered a new form of power. If confidence could be created, value could too. For the first time in history, money itself became the product. What had begun as a rescue became a habit. Whenever growth slowed, interest rates were cut. Whenever markets trembled, more money was printed. And the addiction deepened. Between 2008 and 2020, the world's central banks created over $20 trillion out of nothing. Stocks reached record highs. Housing prices soared again. The same cycle of illusion returned, just with shinier screens and new acronyms. The old lesson that debt without discipline destroys trust was forgotten, because the pain had been postponed.